Good morning, everybody. I have a very strong panel members here today. I have two people. Grace is there from OECD. Mukesh is a vice chairman, heading a vice chair of ICCC tax commission from Paris, especially working on the digital economy. I have two people, Mr. Rasmi sir from board, Mr. Chetan, and a senior litigation lawyer, I can say that, Mr. Venkat. So we are going to hear actually a very divergent thoughts, basically. And what is the best thing about the digital economy? Since yesterday, practically every session has been talking about it. And the reason they are talking about it, I think, is because it still remains unresolved. And it's still in intrigue. Actually, we are deliberating it, talking about it, but we are not being able to converge or reach to any concrete or definitely headway solution is there. And actually, we see digital economy has put a serious strain actually on the tax system prevalent throughout the world. And as the digital taxation is trying to find its base, the two premier bodies, OECD and EU, who are working on this project are unfortunately, or what should I use the word, are on a different path actually. They are totally in divergent thoughts, processes, thinking about it, and that is becoming a very serious challenge to address digital economy. The current debate has actually shifted now. The current debate is not anymore on tax avoidance. The current debate is not on stateless income. The current debate has moved how the taxing rights, how the states should get the fair amount of the taxes, where they believe the citizen of the country contribute to the revenue, to the profit of the digital giants, and hence they need to be paid taxes in the respective jurisdiction. Let me briefly take you to OECD part. I'll just give you a very brief overview what happened in OECD. We are all aware that Action 1 on 2015 did not make any headway, basically. And even the March 2018 interim report of OECD, where we expected, I expected more, basically. We were discussing that. We were definitely expecting there'll be some more definitive way forward coming to address these tax positions or taxing the digital economy or was concerned. Unfortunately, there was no consensus in 2018 report as they did not merit an interim tax as what was proposed by EU. In fact, instead, what did the interim report stated? They choose to further analyze in view of the inherent complexities in addressing the tax issues of digital economy. OECD they agreed that the two principal factors, the nexus one, and the other one was the profit allocation rules, needs to be reworked or needs to be worked more, basically, in view of the intricacies, complexities about digital businesses are concerned. And the OECD further acknowledged that views differ also on the issue, how the issue should be addressed, and they short of recommending any definitive steps, but only issued a general guidance to the jurisdiction, basically, and looking forward to give a consensus-based report by 2020. Now, this is the generic background of OECD's concern, and my first question, which goes to Grace, actually, basically, and she is a part of an OECD, actually. And Grace, what happens, we understand 2015, nothing happened, what could be the reason behind it, but there was a very high expectation of an interim report of 2018 was concerned. My first thought is, what are the impediments you had it? What are the challenges you had it? What are the constraints you had it to give a more focus to address this digital, taxing the digital businesses are concerned?
Okay, well, first let me say I'm sorry you had those high expectations of the interim report because, frankly, when we were first tasked with writing this interim report, we ourselves within the OECD did not have terribly high expectations. Why is that? It's because of where we left off on Action 1 in 2015. And there, as you rightly pointed out, we basically said that we need to see how the BEPS measures, the other BEPS measures play out to address some of the issues that countries are concerned about in the new, more highly digitalized economy. But we did not come out with a specific solution to the so-called digital economy. And part of the reason, a big part of the reason, was that all countries agreed in that report that you cannot ring-fence the digital economy, that the whole economy is becoming increasingly digitalized. And so it really is more a question of whether you have highly digitalized businesses versus less digitalized businesses, but it is not a question of ring-fencing a particular segment of the economy as a digital economy. We did not have at that time a willingness, or a consensus, I should say. We certainly had willingness among some countries. We did not have consensus to take a look at these broader tax challenges that would not be resolved simply by the BEPS issues. We just didn't have that. We had some countries, and I think everyone's pretty aware, the US at that time was saying, no, we're not doing anything further. Let's come back to this in 2020 and see if anything substantial has changed. But in the meantime, we can see how the BEPS measures, the other BEPS measures, have played out to deal with this issue. And so that's where we left it. And we in the OECD didn't see that much prospect for advancement in this. What we did do in that Action 15 report, recognizing that we had no consensus, we also recognized that countries were going to take unilateral measures, because there were some countries that were very keen and took a different view and wanted to impose some sort of tax. And so we outlined 3 options. The OECD did not recommend any of these 3 options: the significant economic presence PE, or a withholding tax, or an equalization levy. What it did was set out that these are possibilities. It set out some of the pros and cons, the challenges that would need to be dealt with, and most importantly said, if countries are going to go down any of these paths, they should keep in mind their international obligations, including their tax treaty obligations. Obviously, within the EU, they have to keep in mind also their EU limitations, and then there are also WTO issues that have to be dealt with. And so that's why, you know, it's not surprising that India has done what it has done. It was one of the keenest countries to move ahead and do something about the taxation of the digitalized economy. So then the G20 came along and said in 2017, no, we need faster action on this, and more countries were taking action. We need faster action. We recognize you may not get to a solution, but we want at least an interim report. And at that time, really, we were thinking, okay, well, we can do more work on the business models and things that have changed, but in that short period of time between the end of 2015 and 2017, we didn't really think that we would be able to get a consensus or some new solution by this interim report. That's why it's called an interim report. But we do think, contrary to maybe what you think, is that we have made substantial headway in the interim. Why is that? Because we feel like we have a new openness to discuss issues. And as Andrew Dawson said yesterday, we have now been able to identify basically 3 broad positions among the 119 countries working within the inclusive framework. And that is that you have, and I probably describe this in a different way from most people or the report, but you have a certain group of countries that still thinks, you know, BEPS probably really dealt with most of the issues, and we're pretty happy with the way things have come out. So pretty much not so keen to look at any changes. Then you have another group of countries that says, well, no, actually, there is something a bit different, and that is user contribution, and we're not really taking that into account into the way the current rules are applied. So while we don't need a wholesale change in the international tax rules, we do need something to recognize these differences in highly digitalized businesses. And then we have a third group of countries that says, we recognize there's still some tax challenges here, and that the current international tax rules don't address them adequately, but we do not think that there is a solution that should be found that is restricted to something called the digital economy. We're prepared to discuss broader solutions and changes to the international tax rules. So that in and of itself, identifying that I would say an opening to do something more is quite significant. Separate and apart from that, I think we also within this report were able to further elaborate the rapidly changing business models. And I think this is something that is key to our work going forward, is that as we just heard from the previous speaker, there is a lot of very fast change happening. We cannot anticipate the developments that will happen in the next year, the next 2 years, and yet we, as responsible tax policymakers, need to be able to try to somehow fashion international tax rules that will be sustainable and durable.
Now, on the same, let me take the Government of India views, the taxation views actually. What do you think, sir, what, as a tax department, as a Government of India, basically, you always have been a leader in taxing, like we had an equalization levy, we introduced SEP, basically. Were you disappointed that OECD never gave you a concrete, converge view, okay, let's move forward in taxing it? And see where my concern comes. Digital one, Action 1 was conceived in 2013. By the time the first report comes, the final report comes, it will be 2020. By the time this report is implemented, I just take it in a couple of years, 2022, 23, it will be close to 10 years. By the time we will be, hopefully, able to tax the digital economy in a coordinated, convergent way, basically. Now, this is my concern. And where is my second concern? By that time, digital economy will become a monster. Digital economy will be there. There will be every sector of this world, any activity will have a digitalized business, will be there, basically. Do you think as a tax people, you will be able to keep pace with this? Or by the time you come back and implement OECD 2022, 23, I think digital economy, there will be a boom. Or we will be left gasping, actually. So your thoughts, sir?
Yes. Thank you, Ms. Nangia. Actually, let us be very clear. The interim report is not, strictly speaking, an OECD report. It's a report of 110 inclusive, 119 now, countries of inclusive framework, where all the countries participate on equal basis, and it's at the mandate of the G20 finance ministers. And I agree with you. I mean, in India, particularly, we are more concerned because we feel, in our case, for a country like India, the base erosion is huge. We think we are losing huge revenue. That is why we always have tried, while we have always tried for the international consensus, we have also taken steps where it is necessary in our national interest to do so. That is why we went for equalization levy. Equalization levy is more as a policy statement, where we stand. That's what I think we would like to believe, that because we took those steps and because other countries have taken such steps or have thought about taking those steps, that is why there is an increasing urgency among all countries to reach a consensus. So far as the interim report is concerned, I agree with Grace. I think nobody expected. We are deeply involved in, by both me and my colleague, we are involved in preparation of that report. Nobody expected a detailed solution on this. But what is the takeaway from Indian point of view? From Indian point of view in this report, we are not definitely disappointed. We are not thrilled. But we take there are several positives. You know, for the first time, it's a report which recognizes India's concern that when you allocate or you rewrite tax rules, apart from the supply side factors, you have to take into demand side factors. We have been saying this all along. For the first time, some major countries have supported us. That's a one step forward. The second thing which Grace referred to is that among the 119 countries, we know where the countries stand. You know, when you go for international consensus, you need to know what is the country position. Then only we can negotiate. So after the interim report, we now know all countries now, broadly, majority of countries now realize that majority of the countries do not agree or see a problem with the existing international tax rules. That is why we have this Australia's MAL, UK's DBT, or the recent tax reforms in the United States, which came and which did not come. So now, if you look at after March, the next meeting which took place in July, the discussion among countries was on specific solutions to the problem. So I think we have moved forward. And as much as we would like to have a solution next day, tomorrow, or day after, you know, end of the day we have to realize that we have to have an international consensus which requires more than 120 countries to agree. So it will take time, but I think every country now realizes we need to reach some consensus. So we are very positive about it.
Okay, thank you, sir. Mukesh, now, you have been very well deeply involved in digital economy and initiatives are concerned. And, in OECD report, the two issues which were there, the taxation of digital economy, one is the nexus rule and the profit allocation rules. And obviously, there needs to be reviewed or relooked or reworked from the digital taxation point of view is concerned, basically. I personally believe when you're in a digital economy, there's a very high level of subjectivity in applying these allocation rules are concerned. What OECD is doing it basically on that? What are your thoughts on that is concerned? And take me to the next level. You are also a champion of dispute resolution. I just want to know how much work has been done on this thing, basically. We reach to that, how are you going to allocate? I think globally, domestically, I find a high level of subjectivity on it.
I largely echo views of Mr. Ranjan and Grace, yours as well, that the interim report was not expected to give you a full solution. I think we have to recognize that if you take the BEPS 15 action points, the most industry that is getting impacted by several action points is digital. Because you just don't have action point 1, but you have action point 7, you have action point 8 to 10, which deals with value drivers. You have action point 13, which deals with CBCR, and of course, 14 is common, and 15 is common for everyone. If you look at the interim report was supposed to be taking forward the OECD work on profit attribution. The profit attribution work is not just confined to digital businesses. The profit attribution work is confined to non-digital businesses because there were several changes made on action point or expected to be made on action point that deals with artificial avoidance of PE. So whether you look at commissioner arrangements within the EU nations, or you look at the warehousing arrangements, or you look at extending the concept of dependent agent PE, all of these are non-digital. So I think there is an enhanced expectation that the profit attribution report or interim report would have given you a solution for how profit attribution has to be looked at for not just non-digital business, but even for digital business. I don't think it is going to be an easy task, but I agree with Grace that the categorization or stratification of countries in these three categories, in my view, is going to lead to another interim report. I don't think, and I'm guessing and speculating, the report will not still be the final report. But I think the fundamental flaw of digital taxation, in my view, lies in action point 1. My personal feeling is that action point 1 was a rushed report. The options that were given in action point 1 did give some form of a license or a moral authority to jurisdictions to have what is now the world labeling as unilateral measure. So whether it's a diverted profit tax in Australia or in the UK, or it's equalization levy in India, or Israel's significant economic presence, which everyone has labeled this as unilateral action, that error was committed in action point 1. I think that there should have been safeguards as a part of the EU project to prevent, well, it can't prevent because it's a sovereign function, to have at least some limitations to what extent can countries make use of action point 1 recommendations, opt for these 3 options, and go in for unilateral levies. Now let's look at the EU decision yesterday, and this is a tweet that I was reading out to Grace just in the morning. The legal cell for EU, and I know, Grace, you will argue that OECD is not EU. The legal cell of the EU has said that the digital taxation as proposed in the EU report is violative of Article 113 and 115 of the EU directives, and these are not indirect taxes. Now this puts a whole lot of instability, at least within the EU region, to have any form of digital taxation which is viewed as a taxation on services. I think the flaw also lies in the fact, and this is what all the experts expressed a view immediately after action point 1, that many nations will run into domestic constitutional challenges for having levied a tax which is not a tax on income. Many nations could also run into the challenges that EU is running into, that it is not service. And if it is a service, the rendition of service is not in the nation in which you can levy indirect tax. What would have been ideal for many countries, particularly with India, where we have perfected the art of levying taxation on presumptive basis, is to say that we will levy tax, we will use the gross revenues as a base, but we will have a very normative rate of deemed profit. And the reason for the normative rate of deemed profit is very simple. You basically do not know what money are internet companies making or what profitability is an digital business deriving from. And there is wide-ranging limits on how much profits are really made by digital businesses. So you could function on a normative deemed profit rate. By doing that, you of course will have to make sure that such a tax which is levied on deemed profit basis is creditable insofar as treaty is concerned. So we have a digital and an equalization levy in our country, which is neither income tax nor a GST. It's not creditable, and it's levied dehodes of permanent establishment requirement, and as many of the experts have been expressing a view that it is open for a constitutional challenge.
See, any debate of taxability of digital economy is not complete till we don't see the holistic view the world is taking it. We just had a panelist view on the OECD is concerned, where there are 119 countries now, but EU also have a block of 28 countries, and I think it's very, very important to understand what EU is doing it, to understand the holistic view, how the world is heading towards taxability of digital economy is concerned. Discussions in EU intensified in 2017 only, lately only, and they came up with two short-term and long-term solutions. And these series of measures were to ensure an efficient and fair taxation of digital businesses in EU countries are concerned. And the Commission actually believes, importantly, there's a serious mismatch in the taxability and where the value is created. And to combat this perceived mismatch, the EU released two models this year, basically, and they are two digital proposals, unlike not has come out of OECD till yet, and which I'm going to discuss right now. Now, what is my worry actually? My concern is you have an OECD, a complete different format of taxability of digital economy, EU thinking totally differently, the world will have two systems, and US will have its own system which will not subscribe to OECD, will not subscribe to EU is concerned, and that will be the third system which is there. US is coming out with a totally independent thought process, disagree with OECD, disagree with EU, maybe because the tech giants are there, they want to protect them, and they believe we don't need to ring fence the digital economy. They believe the existing laws are enough to tax it, and they believe it, taxing it, working on it totally independently. I don't know where we are heading for as regarding US is concerned, in this part is concerned. Mr. Chetan, I have one thing basically, like US went ahead and came up with two proposals. One was digital service tax and the other was digital permanent establishment. I need to understand basically how does it differ, how does it is going to work actually, and will it work in harmony with OECD? Or they will be just totally independent, they will not think what OECD is doing, it EU comes there, so you have your own regulations, we have our own regulations. Will there be a lot of basically, there will be harmony or there will be conflict between OECD and EU while you implement this report, ultimate report?
Thank you, Mr. Nangia. First, I'll just delve into the two EU proposals, and then I will come to the second part of the question. If you see, as you have rightly pointed out, that one of the main bases for the EU proposals was that there's a mismatch of profits, where the profits are being generated and where the taxes are being paid. And due to this, they came up with two proposals. One was the long-term proposal and other was the short-term proposal. The long-term proposal looked at the significant digital presence. So they said that the nexus will be established by the significant digital presence, and then you have the thresholds for that, which is the Euro 7, if the sale in any member state is above 7 million euros, if the number of users are above 1 lakh, and if the contracts are more than 3,000. So This is or condition, any one of them if it is fulfilled. And then they said that we will follow the OECD authorized approach, and we will allocate the profits according to the FAR, and we will, for that we will use the functional analysis of the significant activities that are taking place, and also for the intangibles there will be the DEMPI function, and this will be without the significant people functions. So that was the whole long-term proposal. This long-term proposal is presently a proposal which is not under really discussion, because the main real discussion presently that is going on in EU is relating to the interim proposal, which is of the digital service tax. So since it was expressed in the directive that we don't know when a consensus will be reached, when a long-term solution will come, so there is loss of revenue, so we need to, the EU thinks that they need a interim solution. And that interim solution has been proposed in the sense of a 3% levy on the digital services that are being rendered they have identified major 3 streams of income. One is from the online advertising revenue. The secondly is from the sale of user data. And the third is from the intermediary services that are being provided. And again, they have set up that the thresholds for it. The thresholds are that the global income revenue of the companies should be 750 euro million, and in the local member states, for the EU zone, it should be 50 million euro. And if you see this, that this is not really similar to what the interim solution was, but it's a bit different, and they have termed it as indirect tax, and how they allocate it is as per the users, where the users are in the various member states. So these are the 2 proposals. If you look at it, when you say that they're not in harmony, so that is a question with OECD proposal. See, it is a country's whole, EU as a bloc, as a whole stand, what they wanted. And if you see, it came out exactly at the same time when the interim report had come. So they were aware of what proposals were going on in the interim report, but probably if you see, any country's position is not dictated by its logic, because there are various things. There's a position a country holds, there are interests that a country as a bloc, EU holds. So accordingly, they had put up this proposal. And regarding the long-term proposal, there are many proposals on the table that are being discussed in the task force on digital economy, and it is one of the proposals. So let us see ultimately how consensus develops. And I believe they're pretty smart people everywhere, and something or the other will come up. But again, just as you mentioned, there is danger that once we come up with some rules, the whole economy would have changed probably. But that is why it is very important that whatever rules we frame now are take care of what could be the future possibilities. Thank you.
Yes, if I may just add to that. One, I don't think we can say that there is an inconsistency with the OECD proposals and the EU proposals or any other proposals, because at the moment, there is no OECD proposal. What you saw in the Action 1 report from 2015, in a sense, is old news. Those were not specific proposals. They were options that countries could consider, but they were not recommended by the OECD. Right now, I mean, I think you really should see the OECD situation and the task for the task force as having a blank sheet of paper where they can develop a proposal. The other thing I would say is that there isn't a US position that is in contravention to an OECD approach. In fact, there are other countries that also think we should not develop a proposal that is specifically targeted at the digital economy. The other thing is that there is no inconsistency between having an interim measure and having a long-term measure. The interim measure that the EU is considering is just an attempt to try and fill a gap until a long-term solution is identified. And they have specifically said in their proposal that they look forward to having a long-term solution come out of the OECD, and that the significant economic presence PE type approach that they have included as a long-term proposal is basically food for thought for the OECD to consider. So I think it needs to be clear that right now we are in the process of developing a solution.
Thank you for the value addition, Grace. So, Mr. Venkat, sir, now you have been a part of litigation. Now I have two questions for you basically on for this subject. This DST, which Mr. Chetan just mentioned, is 3% of digital service tax. Do you think this becomes a high cost of businesses once it is levied, actually? That's my first question. And this will be even applicable for the loss-making companies, like excise duty, basically, akin to excise duty is concerned. It is not a substitute to corporate income tax. This is my first question. Does this form a no income? You are taxing them higher, that's one part. And second, what we've discussed on this subject, all of us, any value addition input which you'd like to give, what we share in this first session?
I will take the second question first, and the first question second. See, we should understand the distinction between tangible PE and a digital PE. This conception is very important for a policymaker, for a business, and for a lawyer who is going to defend the cases in future. A brick and mortar had little radius in capturing business qua his customers. Now, you start creating branches, chain in different places, then you expand your business. Then somebody who's an MNC comes into the country, puts up an agent, or then they expand the business. All this was in tangible forms. Now you have technology, you can sit anywhere and populate your footprints in any country. Because it is intangible, we need to identify the old rules can't serve the purpose. You need to therefore factor whatever your plans are, short term, medium term, or long term. You have to factor the components both at the demand stage and the supply stage. If you're going to miss one or try to create an imbalance between the two, this solution, we will not have a final solution. So now come to the supply side, the recipient side, which is what India is all about. In technology fields, in technology laws, like competition law, telecom sector, we have identified components. We have the significant economic presence. We have a similar definition in TROI laws, significant market player. Now, the two major components in any form of digital businesses, one is gross revenues, another is gross consumption base. These are two tangible quotients available to you in any country. You must find similar tangible forms at the demand stage, the kind of infrastructure he employs, the kind of people, the kind of capital, all that goes into it. Take both the components and can you create a balance? Unless you factor both, we will not reach a golden middle. I think we have not done that. For example, the definition of SCP in the tax law today is overarching. It doesn't just apply to digital. They are redefining PE even for other establishments. So this is one concern. Whoever is the policy maker should bear it in mind. Coming to the interim measure of putting an equalizing levy. In India at least, you can always say Parliament has a supremacy. Whenever you don't find a basket for tax entry, you have a residual basket called entry 97. So they can always say we have the power to tax you. So that's not a problem. But when you choose to tax, you are forced to identify a taxable event. That's an obligation. Now if you see the definition, it says it's a tax on services because they are putting it on a destination based. Either it has to be origination or it has to be destination. If it is destination, it becomes an indirect tax. And therefore, you must give a credit in India. If it is an origin base, then it becomes an income tax. You have to give us the treaty benefit. Now, they don't give both. They want 6% as a captured revenue in India. Looks to be, they may have the power under native. See, it's like a spectrum fee, a right to use. So you say, it's a right to enter into India, I'm taxing it. Then the whole mechanism of collection, creating a system for it, an enactment to it has to follow. If you piggy bank on existing tax laws, then you may have to call it as a destination-based service tax or as an origination-based income tax. You can't say it's an equalizing levy which is independent of both. Looks to be a possible challenge in the long run. If you are now today the two businesses which you are taxing is ready to absorb it. If you extend it to more, then the levy can come up for a consideration. Now the final point, whenever there has been mixed, in fact me and my teacher Mr. P.V. Srinivasan, whom I learned the whole law, spending a lot of time, we have done a lot of research in the past also. In India, the composite matters have been discerned carefully through process. We are not new to this. At least I am not surprised that this confusion is happening across the globe. Whenever you have to factor more than one element, you must have two things. Identifying the components is one process. Then the attribution. Attribution, go for actuals and also go for a formula. This is the only long-term solution for digital taxation, or else we will be taxing $100 twice in both the jurisdictions.
That's a very important thing. Let me, before we move to the next, see what was my concern and what becomes true also. I was reading just a couple of days back. The latest report shows in last few days that there are already fissures in EU proposal of applying DST. Ireland, Czech, Nordic countries have already started opposing DST in EU. And they believe that this is not in line with the treaties in EU and hence not compatible and as a premature step. The consensus, which EU works with the consensus, we can see the cracks started just happening right now. And let's take it a very important thing, and you have giants, tech giants, and you need to tax them. And there's becoming a serious political fallout. And let me close this session. What was a statement given by a political party? If we are, quote unquote, if we are incapable of re-establishing a fair tax system to tax digital giants, we will have to pay the price at the ballot boxes, at the ballot box. Grace, any comment on this? Short comment. I have to go to the second.
Yes, it is true what you said about the fact that there are fissures in the EU. They are racing to try and get unanimity on this interim measure by December. Why? It's for political reasons. They have parliamentary elections next year, and that pretty much stops any possibility of passing something. So there is tremendous pressure to get an interim solution, and if they don't get it, well, we will continue working on the final solution.
So I move to the other part now. Another which is my concern, I'm going to ask my team actually, this diversity of this digital business model actually is basically, you see, what we were looking for. Basically, we were looking for a single effective measure to tax the D, which is finding it very challenging, basically. And OECD and EU, basically, they were frustrated and there was a lack of progress. And what exactly happened? What was the area of concern? That individual jurisdictions started levying taxes of their own, the way they fed politically, socially, whatever they wanted to tax the digital economy was concerned. And see what exactly happened. Spain have a DST of 3%, Austria is saying 3, 4, 5%. Austria said we are going to have their own laws. Italy has a web tax of 3%. Slovakia has its own digital platform tax. Hungary has introduced internet taxes. India has its own position. Israel, Italy to levy taxes on digital transactions. France on audiovisual content. A long list was everybody started taxing at this. And this was a concern of all this international, I think so, of international tax bodies. They wanted to avoid that, so that jurisdictions should not come like this inconsistent load, because this will lead to high taxation from no taxation. But unfortunately, because of domestic, political, social pressures, this unilateral issues became inevitable. Mukesh, now, I have this question for you, basically. You have been working on it a lot. Do you see this unilateral action, do they really give you any direction, or they make it directionless? And I'm using a little form of statement. Are you seeing a little bit of chaotic situation coming and levying, because there's a desperate situation coming to tax them? So you just come out and tax them.
Well, I'm first glad to hear that many of the measures which are viewed by the world or the business as unilateral measures are interim. So if I just try and draw a parallel with India, I consider equalization levy as an interim measure. Having said that, I also equally feel strongly that the world has moved on, and the businesses who believe that a digital presence, since it does not have a classical brick and mortar presence, does not constitute a PE in the new world order, are more in minority. So even if the BEPS action plans had not devoted the kind of effort that it has devoted, I think the political and the civil society movement has moved to a debate not about whether to tax or not, but how much to tax. So there are two important aspects that assume significance in my view. I see the world as moving more from such unilateral levies, such as the equalization levy, to significant economic presence, the virtual PE. And if that be the case, there are two important things that businesses and administrations have to answer, and OECD plays a very important role as part of the BEPS mandate. How much to tax, and how do you allocate the taxing rights between two nations? And these are very, very two simple questions that we need to answer. So if every country is left to design its own equivalent of significant economic presence, it's not going to be able to answer the second question. How do you allocate the rights? One of the reasons in my previous proposition I mentioned that it should be taxed and the tax should be creditable. The other reason for that is that in case, for the second principle, there are differences between nations about allocation of taxing rights, then those can be resolved only through the dispute resolution process. So, as far as the allocation is concerned, I think there is fair bit of guidance that's available in Action Point 1 on digital presence, which got to do with domain name, intermediaries, payment system, customer base, so on and so forth. And you can pick up, and choose from a variety of menu that you will have. At least that will reduce the friction between various nations, because the laws have to be legislated at the domestic level. I think one of the aspects that has not been comprehensively dealt with in Action Point 1 is, are all digital businesses alike? In my view, no. Most experts feel that digital businesses fall in really 4 categories. Category 1, businesses that have been operating through the brick and mortar model, and they have graduated, moved up the value chain, and they have a digital model. 2, businesses that purely offer digital services. Now, businesses that offer digital services is because the very nature of the business is such that they have to offer digital services. 3, businesses that are intermediaries, which are payment systems, so on and so forth. And 4th, the new forms of businesses which are very integrated, largely in the media and telecommunication space. So if you look at broadcasting, you look at television, you look at streaming, all of those will fall in that category. I don't think we can sit over here and envisage which is the 5th and the 6th model that will evolve. For all you know, by the time OECD issues the directions, there will be 5-6 models. So you need to really take Action Point 1 in terms of attributes. What contributes to significant economic presence? You need to put on that the various business models, and then only, a credible solution will evolve insofar as significant economic presence is concerned, and a clear diktat that if there are disputes between nations on allocation rights, those disputes will have to be mandatorily resolved through the MAP process so that the businesses don't have double taxation.
Grace to you. Now, these countries which are like OECD countries coming out with the individual isolated action of taxing it, basically, do you have fear they'll run contrary to the, I know no one knows what will be the final report, and if it is totally in contrast, what will happen then?
Well, I think if we come up with a solution, which I hope we will, that the countries that have helped to craft that solution will then move to that solution. That's sort of the logical sequencing. But I think each country is sovereign, and so they will have to decide whether they want to keep the measures that they have. I mean, if we look at India, for example, and I don't want to put words in Rasmi's mouth, but I think he said, you know, India took the measure of the equalization levy really as a way of demonstrating that India felt very strongly about the issue of the need to tax the digital economy in some way. And I suspect that if India is part of the solution that we ultimately come up with, they will move away from that. But ultimately, that is a decision for India or for any other country that has already taken a step. But I would say, like you mentioned, for example, Spain has moved ahead with legislation along the lines of what the EU has proposed, and what the EU has proposed is interim. So again, I would say Spain would probably get rid of that if we came along with a final solution.
So basically, this thing will continue. You have an interim measures, isolated actions, and then when the
Until
final
you have a final
so
solution.
you have something. A lot of more work needs to be. Will continue to carry on. Actually, it will not end. Actually. So to you, now, basically, the digital economy, my feel the challenge is becoming the whole economy today in itself. It's not, I should use digital economy as a small part of the economy. It is becoming like an omnipresent, actually, and each sector has a digital presence now, basically. Does it raise concern to you of double taxation in any way from no taxation? Does it give you a lot of uncertainty to the businesses with this isolated action? Because there was no taxation, now your taxation, I'm worried about double taxation. So what is your, do you get as a government part, is a concern for you, or do you need to be addressed to the businesses? There will be no double taxation or higher taxation.
Yes, as you said, the digital economy is, it's not possible to ring fence it, it's overall economy now. But again, as the Action 1 report clearly says, the digital business models, the digital economy, have certain features which may not be unique to digital economy, but which exacerbate the base erosion of the source countries or the market countries. So to that extent, I think we need to look at, all countries are looking at to having a solution. Now, till you have a long-term solution that we are working on in the inclusive framework, that will address the queries that you have said, your problems of double taxation and litigation. That's the purpose. If you have a long-term comprehensive solution to address that. Pending that, since the countries taking interim measures we are also equally conscious of double taxation. That is why the rate has to be low, and that is why the way it is formulated has to be simple. So neither it leads to litigation, nor it leads to over-taxation. But again, as I think what Mukesh was telling, neither the India nor world is, it's not unknown to world or to the India of a low rate of tax on gross, whether it is royalty, FTS, and here we have something. But primary purpose is to avoid double taxation or higher taxation. So long as you don't have a comprehensive solution by way of taxation of the net income, any interim measure has to have a very low rate of taxation, which we have also followed. Yes, we are conscious of, that is why the rate has to be low.
Mr. Venkat, your final thought on this final statements.
See, I'll take both the questions. I'll combine it to one, both unilateral and his concern. See, unilateral assertion comes out of what? We are now reaching a stage, every nation is tested, its sovereign power, qua the sovereign obligation. Power is something which you can exercise unilaterally. Obligation is something you have to do it collaterally. And we must understand, signing a treaty is also traceable to a constitutional power. It is not something outside the Constitution or a mere statutory power. That is also traceable to the Constitution only. Constitution authorizes the states to go and sign a treaty. So, this definition of the first, as a council seeing the definition, SCP looks to be overarching because it's an exercise of a sovereign power in aggression, rather than a sovereign power adjusting to the sovereign obligation. When you test because it is so wide and all encompassing. So we have a lot of doubts, and the threat is that the immediate threat is the likelihood is the attempt to read this as a definition not there in the treaty, and therefore benumb the treaty, and therefore start taxing digital and non-digital in India. This is the path that we are apprehensive about. I'm not saying it will happen or it will not happen. Now, if it happens, how do you, as a field administrator, monitor it? Because the legislation is wide, the definition is wide. So the answer there is, it's better you don't exercise unilateral aggression. Better. But if you do it, how far court will match our expectation of balancing between sovereign power and sovereign obligation depends on that court, that bench, that day. So it's left to that discretion. So the real challenge which the trade will face is unilateral exercise needs to be discouraged. And it's going to have serious repercussions in digital taxation. And treaties will automatically become benumb or non-diligent. We are heading towards that path. Better, if you take trade interest into concern, we need to work fast. I leave it there.
Thank you, Mr. Venkat. Now, basically, I think the time is seriously running, and this topic is so complex. Actually, I'm really worried how we are going to finish my agenda, but let me tell you one thing. Indian digital economy will be $1 trillion by 2025, which will be close to 20% of GDP. And OECD recommendation, if that's the size, just imagine when we will get ready from EU, OECD, imagine what will happen by the time. There'll be 3 billion internet users in emerging markets. There'll be 4 trillion digital influence purchases in the emerging market is concerned. And let me give you a final statement. 3 companies' market capitalization is today is almost equivalent to India GDP. Apple, Facebook, Google is close to $2.5 trillion. This is mammoth, this is size, this is what we call a giant digital economy. This is one I thought just to, and in line to taxes, what the India government did, they introduced in this year, in pursuant to OECD discussion and other thing, they went ahead and made a changes in the domestic law by introducing significant economic presence was concerned. And this was to make non-treaty countries, non-treaty jurisdiction basically, which are likely to be affected as of now because of this change in the domestic law is concerned. And hence, an SCP of a non-resident will constitute a business connection in India, and any income attributable to such cases will be subject to tax in India as concerned. The original intent seems to be very good, but actually was only for digital goods, was supposed to be for digital goods. I believe this intent may go astray. And finally, worldwide, we are using the word significant digital presence. Why India use a significant economic presence where you move forward, further away from the digital businesses, even to the non-digital businesses. I don't know what was the intent of this thing, and that's my first question to you, sir. India uses SCP, which is a much, much more wider definition as compared to the global SDP, basically. Was this deliberate, actually? The whole objective was only to tax the digital economy, and the tax government went and moved forward, touching even the non-digital economy is concerned. Why?
Well, I think the concept of this significant digital presence is limited, I would like to believe, because a significant economic presence as a concept is there much earlier. You know, if you look at the domestic corporate tax allocations or other taxation in whether United States or in Canada or in Switzerland, in Bermuda cantons, there is a concept of significant economic presence. As, in fact, when we were drafting our law, other significant economic presence, we looked at such provisions which exist in United States or in Canada and Switzerland. And significant economic presence was talked of as an option, not exactly recommended, but as an option in the Action 1 report. What it is, you know, I think let us be very clear on this, that what we believe, permanent establishment is not a rule. It's a proxy for a rule for taxation. The rule is economic allegiance, which is there since, let us say, whether it's from German author Sands, then whatever it comes in the Four Economists report, or subsequently even talked about by Vogel or by other economists. So the economic allegiance is there where a business participates in the economic life of a country, as the OECD defines it. In fact, not defines, as stated in the report. When a business is able to have a continuous and purposive interaction with customers, there is a significant economic presence, and India's position is clear on this. You know, if you look at the OECD Convention on Article 5, India has reserved its right to include a significant economic presence as referred to in Action 1 report in its treaties with its partners. So that is what significant economic presence, in that context, it has been come in the Act very clearly. Let me be very clear on this. It will apply, as Mr. Nangia has also clarified, only if there is no treaty, it doesn't apply, it doesn't override the treaty. Second, it is not intended, as the explanatory memorandum accompanying the law clearly clarified, it is not intended to tax pure and simple imports. It is not a destination-based tax. Let us be very clear on this. It is a tax where a company or an entity is deriving substantial revenue from India by participating in the economic life of the country. You know, there it is targeted there, because it is here that in the absence of the physical presence also it is able to go around the existing rules, so India is unable to tax. That is what we feel is the ultimate long-term solution is, and as Grace has said, I again repeat it, we also feel that equalization levy is an interim measure till we find a comprehensive solution, which we are working on it. To that extent, I think there is no contradiction between EU approach, they have a solution, other countries have given solution, we also feel SEP is a solution. We are prepared to look at any solution in addition to SEP also. If something can comes up at international forum, the international consent, that is what we are working at. But pending that, as Mr. Nangia has also referred to, the way the digital economy is affecting our economy, the way it is taking the proportion of the Indian economy, government perhaps thinks it cannot wait. That is why we have come up with an interim measure till we succeed in our endeavor with other countries to get a comprehensive long-term solution.
So this SEP will have limited minimal effect as of now, because it will be only applicable for non-treaties concerned. And my opinion, till the global attribution rules comes, the government will not really be able to make it a fruitful use of this provision the law is concerned. Chetan,
It's actually very assuring. If you say that SEP will be confined to non-treaty, it's very assuring. That's a nice statement from us.
It have to come in MLI, sir.
It's clearly stated in the explanatory memorandum, which is in the parliament, which was given. It will not apply to, it will apply to treaties, will apply wherever treaty. So it will not override the treaty. It is this doesn't override the treaties. And we have treaties with 94 countries, which covers our almost 99% of our transactions. So I don't think.
Chetan, tell me one thing. What is the basis of taxation where there is no physical presence cases? I know whether it's a monetary threshold, clicks threshold, user threshold, market share threshold. I felt it's a very highly technical, complex, and you really need analytical models to really dissect that. Briefly, actually, really briefly.
Yeah, I know we are short of time. I'll just be very brief. See, there are two things. One is value, okay? Value is something that still all countries, even tax researchers, even academics are working on. So this is an area where a lot of work is going on. There are various ways in which, and not only the tax people are looking on in their domain, but also in other domains, in how other regulatory laws are what are the benchmarks, what are the indicators, and how this can be done. So there are various proposals like the digital dividend index is there, which takes care into the demand and supply factors and the various indicators. But briefly, that India's position has always been that whatever profit attribution has to be done, the demand and the supply factors have to be taken into consideration. And this is basically based on a very sound economic theory, and a theory which is long back, that if you see profit of any product is what? Profit of any product is price into quantity minus the cost. And price and quantity are determined by the factors of demand and supply. So this is something that has to be there. Thank you.
I think one of the key drivers in the entire taxation of the digital economy, which I believe is the data actually. And data actually lies in the heart of digital business model. They fuel value creation. And they can create significant value when it is correctly and rightly harnessed and translated into the business. Data is a unique asset, actually. It does not exist in the balance sheet. Unlike other asset which depreciates, data is regenerative. It can be used, it can be reused, it can be multiple use of the same data, and it can unleash new values every time you use it. It can be consumed by multiple parties at the same time without getting depleted. This is the data, this is the power which the digital economy has it. And the different type of data, which I'm not going to do that. Mukesh, we have one minute only left there. The next challenge is how you determine the value by data. We have only we have a warning there. I requested for 5-7 minutes, so they have given me that. Sorry.
Well, I answered that question earlier. The stratification of business, will necessarily force you to look at what is the value of this data for each of the business. So for example, what is the value of the data that's with Facebook is different than the value of data it's with Amazon, or different than the value of data with Google. And what is the revenue model of each of these businesses? So if you are providing digital services and there is no alternative to that digital services, the value of the data is far more important to that business. If you are a Facebook, then the value of the data is to the extent you monetize that data and to the extent you keep on building on that data and build a strong advertising model. So I don't think that there is a one solution fits all for valuing a data. I also feel that action point 8 to 10 does help you evolve strategies as to how do you sit and value the data. I'd just like to make 2 points over here. Number one, who owns that data? And how do you tax that data? Do you tax the data when you monetize it? Or do you tax the data when it's left unmonetized? And more importantly, how do you allocate the taxing rights between various jurisdictions as to who taxes the data? Because if jurisdictions are going to fight over who taxes the data, then you're going to really
And
have
data
the same
can be
situation.
meaningless and useless for some person also. Last 1 minute, Grace. I'm sorry, I see the red sign there.
I hope the world will move shortly from economic presence to digital presence. That's better. That definition should be substituted at some point of time, confining it to digital technology.
I can only say that with the closingly that this cost of doing business, digital tax, should now have to be factored in all strategic business decisions are concerned. This is very clear. I do see some light at the end of the distant light at the end of the tunnel, but I do not know how long the tunnel is. Thank you so much, everybody. Thank you.